It looks like silver is crashing again. Prices drop in the US, headlines scream weakness, and traders panic. But here's the part they don't want you to look at. At the exact same time, silver is being dumped on American exchanges. Buyers in China are paying as much as 30% more for the very same metal. Same silver, that same global market. To completely different prices. That's not a coincidence, and it's not free market behavior, it's a signal. And once you see it, you can't unsee it. If silver were truly oversupplied, prices would fall everywhere. If demand were weak, buyers in Asia wouldn't be fighting to secure physical metal at massive premiums. Yet, that's exactly what's happening right now. The US paper price collapses, while real-world buyers overseas quietly pay up and take delivery. That disconnect is the story, and today we're breaking down why it exists, who benefits from it, and why it can't last forever. Before we go any further, make sure you like this video and subscribe to the channel. Edion Silver Gold Insider. We focus on what's really happening behind the price charts, not the surface-level noise. Subscribing helps you stay ahead of moves most investors only understand after it's too late. Now, let's talk about how silver is actually priced in the United States. The number you see on financial news isn't set by people buying bars and coins. It's set by paper contracts, futures traded in massive volumes on exchanges like COMEX. These contracts represent silver that often never changes hands. They're rolled over, leveraged, and traded by banks and funds that have no intention of taking delivery. In simple terms, the US price is dominated by promises, not metal. China plays a very different game. Buyers their focus on physical supply. Industrial users, refiners, and long-term holders are securing real silver for real use. When supply tightens, they don't sell futures. They pay higher prices to make sure shipments arrive. That's why premiums in Shanghai rise while New York prices fall. One market trades paper confidence. The other trades physical necessity. This gap keeps widening, and it's not sustainable. Every ounce sold cheaply on paper encourages more physical buying elsewhere. Every price smash in the US pushes real silver into stronger hands overseas. And slowly, quietly, the West loses control over the metal it claims to price. Dev me! Because what happens next explains why these price crashes may actually be the strongest signal silver investors can get. To understand why this matters so much, you need to look at who dominates silver trading in the United States. A small group of large financial institutions controls an outsized portion of futures volume. These players can sell enormous amounts of paper silver in seconds, creating sudden price drops that look like natural market fear. But nothing about it is natural. Physical demand doesn't disappear in 10 minutes. Minds don't suddenly flood the market overnight. Yet, prices crash anyway, because the paper market allows it. When prices fall sharply, retail investors are shaken out. Stop losses are hit. Sentiment turns bearish. Media narratives quickly shift to silver is weak or demand is slowing. Meanwhile, something very different is happening quietly in the background. Lower paper prices trigger buying from industrial users and foreign buyers who understand the real supply picture. China is one of the biggest beneficiaries of this system. China doesn't need to crash prices publicly, it simply waits. When Western markets push silver lower through paper selling, Chinese buyers step in and absorb physical supply. That's why premiums in China rise even as US prices fall. They're not speculating. They're securing inventory. Silver is critical for electronics, solar panels, medical equipment, and advanced manufacturing. For China, Silver isn't a trade, it's a strategic resource. This is where the 30% premium becomes impossible to ignore. Paying that much more only makes sense if supply is tight and future availability is uncertain. No rational buyer overpays unless the metal is hard to get. That premium is a message from the physical market saying the paper price is wrong. And here's the uncomfortable truth. The longer this system continues, the more silver leaves Western vaults and moves east. Every suppressed price is an invitation for foreign buyers to drain supply at a discount. Over time, this weakens the very system that sets the price. You can't endlessly sell what you don't have without consequences. History shows this pattern again and again. First comes denial, then comes strain. Then comes a sudden repricing when physical demand overwhelms paper promises. When that moment arrives, prices don't move slowly, they gap higher. And the people who sold into the paper crash are left wondering how silver went from dead money to unobtainable almost overnight. If this is already making you rethink recent price drops, that's exactly the point. These moves aren't meant to help you. They're meant to transfer metal from weak hands to strong ones. From impatient sellers to long-term buyers who understand what's really happening. And we're just getting started. Because the next piece of this story explains why US investors are being shown one version of silver, while the rest of the world is preparing for something very different. The biggest mistake most investors make is assuming there is one global silver market. In reality, there are two. One is the financial market, driven by derivatives, leverage, and short-term positioning. The other is the physical market, driven by real-world supply, manufacturing demand, and long-term planning. These two markets are supposed to stay connected. But right now they're drifting further apart than at any time in recent history. In the US, silver is treated like a trading vehicle. It's something to flip, hedge, or short. Price movements are measured in minutes and hours. In China and much of Asia, silver is treated like inventory. It's stockpiled, stored, and planned around for years. That difference in mindset explains almost everything you're seeing. When Western traders see falling prices, they see risk. When Eastern buyers see falling prices, they see opportunity. And because paper markets can push prices down without moving metal, physical buyers get a gift. They're effectively allowed to buy real silver at prices that don't reflect real scarcity. This is also why official supply statistics can be so misleading. On paper, there always seems to be enough silver. Futures contracts are rolled forward. Vault reports show adequate inventories. But what those reports don't show is how much of that silver is already spoken for, leased, or double counted. They also don't teach how fast metal leaves the system once buyers demand delivery instead of settlement. China understands this vulnerability. That's why it has spent years building its own exchanges, its own pricing mechanisms, and its own physical reserves. Paying a higher price today is worth it if it guarantees supply tomorrow. From that perspective, a 30% premium isn't expensive, it's insurance. For US investors watching prices fall, the messaging is clear and constant. Silver is volatile. Silver is risky. Silver underperforms. But that narrative collapses the moment you zoom out and compare it to physical demand. Industrial use isn't shrinking. Green energy demand isn't slowing. And global mine supply isn't growing fast enough to cover future needs. So why does the price keep falling? Because the paper market can overpower fundamentals for long periods of time. But it can't do it forever. Eventually, physical reality asserts itself. When enough buyers demand delivery, when enough supply is locked away, the paper price loses credibility. That's the point where the two markets are forced back together. And when that happens, it's not the physical price that adjusts downward. It's the paper price that snaps higher to catch up. This is why moments of extreme price divergence matter so much. They're not signs of weakness. They're signs of stress. And stress in a leveraged system doesn't resolve quietly. Stay with me, because the next part explains why these price crashes keep happening at the worst possible times, and why they often signal the exact opposite of what most people think. If you've noticed that silver prices tend to crash during moments of rising inflation, geopolitical tension, or financial uncertainty, you're not imagining it. These are the exact times when silver should be strengthening. Instead, the price is often pushed lower, confusing investors and shaking confidence. This isn't accidental timing, it's strategic. Price smashes are most effective when fear is already high. When markets are nervous, a sudden drop feels like confirmation that something is wrong. Investors sell first and ask questions later. That emotional reaction is what paper traders rely on. By flooding the market with sell orders during thin liquidity, prices can be forced down rapidly, even when the underlying demand is strong. Meanwhile, physical buyers aren't emotional. They're patient. They wait for these moments because they know the difference between price and value. Every engineered drop transfers metal away from speculators and toward entities that plan to hold it long term. This is how control slowly shifts without headlines or alarms. Another factor almost never discussed is settlement pressure. Futures contracts are designed to be cash settled, not delivered. Most participants never ask for metal. But when too many people decide they want delivery at the same time, the system strains. Price suppression helps prevent that. Lower prices reduce the incentive to stand for delivery and make cash settlement more appealing. China's willingness to pay higher prices breaks that illusion. It signals that real silver is worth more than the paper number suggests. It also signals confidence. Confidence that supply will tighten further. Confidence that silver will be harder to source in the future. And confidence that short-term volatility is irrelevant compared to long-term access. This creates a silent competition. Western markets race to push prices down, Eastern markets quietly accumulate. One side measures success in quarterly performance. The other measures it in decades. That difference determines who ends up holding the metal when it matters most. For everyday investors, this environment is deliberately confusing. You're told silver is failing while evidence shows it's being stockpiled. You're shown charts pointing down while premiums point up. This confusion keeps participation low and attention elsewhere. But history shows that suppressed markets don't stay suppressed forever. When they break, they don't warn you. They move violently, reprice quickly, and leave little opportunity to react. The most important question isn't why silver is falling. It's why so many powerful players are working so hard to keep it that way. And that brings us to the deeper reason the US price matters less than ever, and why global demand is quietly rewriting the rules of this market. For decades, the US dollar system has depended on confidence. Confidence in paper assets, confidence in financial markets, and confidence that prices reflect reality. Silver challenges that confidence because it sits at the intersection of money and necessity. It's both a monetary metal and an industrial input. That dual role makes it dangerous to misprice for too long. When silver prices stay artificially low, it sends a false signal to the global economy. It suggests abundance where scarcity is forming. Manufacturers plan based on today's price, not tomorrow's availability. Governments underestimate strategic demand. Investors are discouraged from holding physical assets. All of this benefits a system built on leverage and debt. China understands this dynamic. It doesn't need silver to spike tomorrow. It needs silver to be available 10 and 20 years from now. Paying more today ensures that outcome. That's why its buying is steady, not reactive. It accumulates quietly, without chasing headlines or hype. In contrast, U.S. markets reward short-term behavior. Quarterly returns matter more than long-term resilience. Price stability matters more than supply security. And silver, when priced honestly, threatens both. A rising silver price exposes inflation, weakens trust in currencies, and highlights stress in the financial system. That's why suppression isn't about silver alone. It's about maintaining narratives. As long as silver looks unimportant, it stays ignored. As long as it stays ignored, accumulation can continue without competition. But the physical market is sending a different message. Refiners are reporting longer lead times. Industrial users are locking in contracts earlier than before. Premiums are rising in places where silver is actually consumed. These are not signs of a weak market. They are signs of preparation. This is where many investors get trapped. They wait for confirmation from the price before acting. But by the time price confirms reality, the opportunity is already gone. The biggest moves in commodities don't happen gradually. They happen after long periods of suppression, when pressure finally escapes. What makes this moment different is how visible the disconnect has become. A 30% premium isn't a rounding error, it's a warning. It's the physical market openly disagreeing with the paper market. And when two markets disagree, the one backed by real metal always wins. The question isn't if this gap will close. It's how, and how fast. Because once silver is repriced to reflect true demand, the calm we see today will look very misleading in hindsight. And that leads to what could force the system's hand sooner than most people expect. One of the biggest catalysts that could force this imbalance to resolve is industrial demand. Unlike investment demand, industrial demand doesn't disappear when prices rise. It often increases. Technologies that depend on silver can't simply switch materials overnight. Solar energy, electric vehicles, advanced electronics, medical applications, and defense systems all require silver for its unique properties. There is no perfect substitute. As global energy systems shift, silver consumption keeps climbing. Solar panels alone use significant amounts of silver, and global installations continue to grow. Every new factory, every new grid upgrade, every new data center adds to long-term demand. This demand doesn't care about paper market games. It cares about delivery schedules and supply certainty. At the same time, mine supply remains constrained. New silver mines take years to develop. Many existing mines are aging, and higher production costs are squeezing output. Even when prices rise modestly, supply doesn't respond quickly. This creates a structural problem. Demand grows steadily, while supply struggles to keep up. In this environment, low prices are not a solution. They're a signal failure. They encourage consumption while discouraging investment in new supply. That gap has to be filled somehow, and historically, it's filled by higher prices. China and other industrial-heavy economies are preparing for this reality. They're securing silver now, even at higher prices, because shortages cost far more than premiums. Delayed shipments can shut down factories. Missed production targets ripple through entire supply chains. From that perspective, Paying 30% more today is cheaper than risking disruption tomorrow. U.S. investors rarely hear this side of the story. Instead, they're shown charts and technical patterns, as if silver exists in isolation from the real economy. But commodities don't obey charts forever. They obey physics, chemistry, and logistics. This is why price suppression eventually fails. You can manage sentiment, but you can't manufacture silver on demand. When physical shortages emerge, paper contracts lose their power. At that point, price becomes whatever is necessary to pull metal out of hiding. What's happening now feels quiet to quiet. That's how these transitions usually look right before they accelerate. Demand builds silently. Inventories thin slowly. Then, one disruption exposes how fragile the system has become. When that happens, the question won't be why silver moved higher. It will be why so many people believed it couldn't. And that brings us to the warning signs already flashing beneath the surface, even if most headlines refuse to acknowledge them. One of the clearest warning signs is how often silver rallies are suddenly cut short. You'll see momentum building, sentiment improving, and then, without any major news, the price is slammed lower. These moves don't follow normal trading behavior. They follow control patterns. The goal isn't profit alone. It's discouragement. Repeated failures condition investors to give up. After enough false starts, people stop paying attention. That's when accumulation accelerates. Markets are most vulnerable when participation is lowest, not highest. Another signal is the growing gap between wholesale and retail availability. Coins, bars, and industrial-grade silver often carry premiums that don't match the spot price. Delivery times stretch. Allocated accounts become harder to secure. These are signs of stress that charts don't show. At the same time, official narratives remain calm. There's always enough silver. Inventories are sufficient. Supply chains are fine, but actions tell a different story. Long-term contracts are being locked in earlier. Strategic stockpiles are quietly growing. Physical flows are shifting eastward. This is where silver and gold insider focuses its attention. Not on daily price swings, but on structural changes. Because once those changes reach the surface, it's already too late to prepare. Another overlooked factor is trust. Financial markets function on belief. Belief that contracts will be honored. Belief that settlement will be smooth. Belief that prices reflect reality. When that trust weakens, participants demand more certainty. In commodities, certainty means metal in hand. The more the paper price diverges from physical reality, the more pressure builds. Eventually, someone decides they'd rather have silver than cash. Then another follows, then another. That's how a controlled system becomes unstable. China paying 30%. More isn't just about supply. It's about confidence. Confidence in metal and a lack of confidence in paper promises. That shift doesn't happen overnight. It builds slowly, then shows up all at once. For viewers watching this right now, the most important thing is awareness. Not panic, not speculation. Awareness, understanding why price action looks irrational, is the first step to seeing opportunity where others see confusion. Because when silver finally stops behaving the way it is supposed to, it will start behaving the way it has throughout history. As a store of value, a strategic asset, and a signal that something deeper has changed. And that brings us to what this all means for you, and why the coming phase may reward patience more than anything else. So where does this leave you as an investor or a viewer trying to make sense of all this noise? It means the silver price you see on your screen is only part of the story, and possibly the least important part. What matters more is who is buying, who is holding, and who is quietly willing to pay far more than the official price to secure supply. Markets like to move in cycles. First comes disbelief, then frustration, then boredom. Silver has lived in that boring phase for a long time. And that's usually the final stage before something changes. The biggest moves rarely happen when everyone is excited. They happen when most people have stopped caring. China paying 30% more for silver isn't a headline designed to scare you. It's a clue. A clue that the physical market is preparing for a future that the paper market isn't pricing in yet. When those two futures collide, prices don't adjust gently. They reset. That doesn't mean tomorrow. It doesn't mean next week. But it does mean the longer this disconnect lasts, the more powerful the resolution becomes. Suppression builds pressure. Pressure builds volatility. And volatility rewrites narratives overnight. For those who understand this, the current environment isn't discouraging, it's revealing. It shows you where attention is being pulled away and where value is quietly being stored. History doesn't repeat perfectly, but it does rhyme. And every major repricing of silver followed a long period of confusion, just like this one. If you found this breakdown useful, let us know in the comments. We read them, and your perspective helps shape future videos here on Silver and Gold Insider. Share this video with someone who still thinks silver prices tell the whole story. Because this is a conversation more people need to hear. And if you haven't already, make sure you're subscribed so you don't miss what comes next. These shifts don't announce themselves. They reveal themselves slowly, then all at once. Thanks for watching, and stay alert